Hi everyone, welcome back to my channel. Today I'll be discussing examples of valuable business deductions. The goal of my video is to help you, the small business owner, pay less federal tax so you can keep more of your hard-earned dollars. The trick to paying lower taxes is to take advantage of every tax deduction available to you. Remember, the IRS will never complain if you don't take all the deductions you're entitled to. In fact, the majority of small businesses miss out on many deductions every year simply because they don't know about them, or because they neglect to keep the records necessary to back them up. I will explain the most valuable business deductions and how to deduct all or most of your business expenses. Learn how to take and properly document your travel, home office, and operating expenses, depreciation, and other deductions. Even if you work with a CPA, you need to understand business deductions. Per diem. Per diem means for by the day, a daily allowance. For people traveling away from home overnight on business, the IRS has established two per diem rates, a rate just for meals and tips called meals and incidental expenses, also known as the standard meal allowance, and a rate that includes lodging along with meals and tips called lodging plus M&IE. You are not required to use per diem rates. At your option, you can take either the per diem, if you're eligible, or the actual costs. If the per diem is higher, deduct the per diem. If actual costs are higher, deduct the costs. Note, tips paid for meal services are 50% deductible if you're traveling away from home overnight. Tips for services other than food are fully deductible. Temporary help agency. Fees paid to an agency or service that provides temporary workers are fully deductible. The workers are not your employees. They are employees of the agency, so this is not a payroll expense. Petty cash. Petty cash is a small fund of cash some businesses keep on hand to pay small expenses. Putting money in petty cash fund is not an expense since the money hasn't been spent. When you spend the money, you get the deduction. Some business owners don't bother writing them down since they aren't much at first. But before you know it, these dollar here, dollar there, cash expense from petty cash can grow into significant tax write-offs if you remember to write them down. Children on payroll. You can hire your children and get a deduction for their wages, and within certain limitations, the children are not subject to income tax or payroll taxes. This deduction for your children applies to sole proprietorship, spousal partnerships, spousal joint ventures, and single-member LLC. It does not apply to corporations, regular partnerships, or multi-member LLC. The rules are very specific, but generally, if you have children under 18 years old, you can pay each of your children who qualify up to $12,000 a year tax-free and get a business deduction for the wages. The maximum amount changes from year to year, but it's the same as the standard deduction for unmarried individuals. The children should be doing legitimate business-related work to justify the salary earned. The children do not have to file a federal income tax return, and they owe no federal income taxes. And you, the parent employer, gets a full tax deduction for the wages paid. How awesome is that? If your child has what's called unearned income, such as bank interest, that income cannot exceed $1,050, and the child's total income, wages, and all other taxable sources cannot exceed $12,000. If the child does have excess unearned income, or if the child is earning more than the $12,000 income maximum, he or she is required to file an income tax return. but the child's wages, regardless of the amount paid, are exempt from Social Security and Medicare taxes. You will need to fill out a W-4 payroll forms for each child. Does not need to be sent to the IRS. And at year-end, file W-2 and W-3 payroll forms as you would for any employees, but no payroll taxes are due. You do not need to file a 941 or 944 payroll tax return. For state taxes, check with your state employment department before you hire your children. Many states have similar laws to the IRS, impose no state income or payroll taxes, nor require workers' compensation insurance on your children. Check your state employer's guide. Do not rely on verbal information. People who work at state employment departments are often unaware of child employment laws. Now, on the flip side, children who hire their parents. The parents are considered regular employees, subject to all regular income and employment taxes except FUTA, short for Federal Unemployment Tax. This law does not apply to corporations. Bad debts. Bad debts are deductible only if you recorded the payment as income that you're unable to collect. For example, if you received a check as a payment and you post it to your income ledger, then the customer's check bounced, then it is deductible. Any bank charges are also deductible. However, if a customer owes you money but never pays, you cannot take a bad debt expense for uncollectible accounts. That is, if you use the cash method of accounting, which most small businesses use, because the income was not recorded in the first place. Here is an unfair rule. Unless you are an employee of your own corporation, a self-employed individual cannot take a bad debt deduction for his or her own time devoted to a lousy client or customer who doesn't pay. If you're unable to collect from a client for your time billed to the client, you cannot take the deduction for this lost income. You're out the money you should have earned, and the IRS says tough luck. On a brighter note, you do get a deduction for any inventory or goods you sold that you didn't get paid for. Deduct only those bad debts you're certain are uncollectible. The bad debts should be specifically identified and the amounts cannot be estimated. What about allowance for bad debts or bad debt reserve? An allowance for bad debts, funds set aside for anticipation of a bad debt, is not deductible since such reserves are not really business expenses. Casualty losses. Business losses from fire, storm, or other casualty, or from theft or vandalism are deductible if the items destroyed or stolen have not already been deducted. Assets that have already been deducted, such as machinery and equipment, inventory, supplies, cannot be deducted a second time as a loss. Assets that are being depreciated and not already fully written off, such as buildings, can be depreciated further and only up to the undepreciated balance. Loss or theft of cash is deductible. Cleaning and repairing damage is deductible. Now, any loss covered by insurance is not deductible. If you have insurance, you are required to file a claim with the insurance company, or you cannot take a tax deduction on any of the insured property. Be sure to document your losses. Take photos, make a list of everything affected, and if theft or vandalism is involved, file a police report. Theft and vandalism losses are deducted the year discovered, regardless of the year they occurred. Parking and tolls. Vehicle tolls are deductible. If you take the standard mileage rate, tolls are deductible in addition to the mileage allowance. Business parking costs are deductible. If you take the standard mileage rate, Parking is deductible in addition to the mileage rate. However, parking at your regular place of work is not deductible. The IRS considered this a commuting expense. Freight. Freight costs on goods you sell are deductible. Freight charges for business assets you are buying, such as machinery, equipment, furniture, should be added to the cost of the asset. Freight charges for inventory you are buying are added to the cost of the inventory. Bankruptcy. Costs of filing for bankruptcy and related expenses are deductible. If a supplier goes bankrupt and if you have paid for goods or services not delivered, you can deduct your loss as a bad debt. Dropshipping. Dropshipping is a business arrangement where your business contracts with another business to warehouse and ship products to your customers for you. The dropshipper may be the manufacturer, importer, or wholesaler of the products, selling the products to you but shipping them to your customers for you. Or the dropshipper may simply be a warehouse and shipping service. Goods that you have dropshipped for you are considered inventory even though you never have them in stock. I did a video on inventory and whether it is deductible when purchased. I invite you to watch the video for further explanation on inventory deduction. Now, worthless goods can be written off as inventory. Worthless business assets that have already been fully deducted cannot be deducted a second time. If the assets are being depreciated, the remaining undepreciated balance can be deducted. For example, let's say you bought a piece of equipment a few years ago for $4,000 and you've already taken $2,500 depreciation on it. It dies and isn't worth fixing. Since you've already deducted $2,500, you can only deduct $1,500, which is the undepreciated balance. Well, I hope this gave you some ideas on valuable business deductions you may have missed and how you can account for them. And if you haven't already, please subscribe and give it a thumbs up.